In this video, I'm excited to share with you some charitable contribution strategies that you can implement. These will help you to reduce taxes while supporting your favorite charity. Now, be sure to stick around to the end of this video to learn about an exciting new opportunity for every taxpayer to itemize charitable deductions in 2026. The first strategy is giving appreciated assets. This is most commonly done with stock, although it can also be done with a vehicle or antiques or whatever your favorite charity is willing to accept. The way it works is quite simple. Let's suppose you bought $1,000 worth of stock 10 years ago, and today it's worth $6,000, and you would like to make a donation to your favorite charity. If you sell that stock for $6,000, you have a $5,000 long-term capital gain to pay tax on, leaving you with less cash to donate. If, however, you give that stock to the charity can turn around and sell it for $6,000 and has no capital gain, and you get the benefit of the full $6,000 as a tax deduction on your tax return. Now, the only caveat with this is that if you are giving appreciated assets worth $5,000 or more, you need an appraisal. Now, again, this strategy is most commonly used with stock, and the fair market value that's published is sufficient for an appraisal when you're giving appreciated stock. The next strategy is basically the reverse of the first. It's a tax loss harvesting strategy. Now, this works when your stock is down and you don't expect that it's going to rebound, and so you sell it for a loss and give that cash to the charity. So here's what that could look like. Using a similar example, let's suppose you bought $6,000 worth of stock and now it's only worth $2,000. So you sell it for $2,000 and you make that contribution to charity of $2,000. You get to deduct the $2,000 as a charitable contribution, and you have a $4,000 loss that you can claim on your tax return. You can claim up to $3,000 of that loss against ordinary income, and the rest carries forward, or you can take some gains and have that loss from the stock offset the gains from other stock that you sell. So this is an interesting strategy that doesn't get mentioned a lot, but one that you should consider if you have a stock position that's down and you don't expect it to rebound. The next strategy is a donor advised fund. This is a great strategy for tax planning purposes. The way it works is this. You make a large contribution to a donor advised fund, and that is simply an account that you set up with a brokerage. You get that entire deduction in 1 year, but you don't have to give all of that money in that 1 year. So here's what this would look like in practical purposes. Let's suppose you typically give $10,000 to charity per year, and you decide, I want to make a large contribution. In 1 year, I've got some unique things happening income-wise, and I'd like to offset that. So you put that $100,000 into a donor advised fund. You get the entire $100,000 deduction in that year, and then you can continue out of your donor advised fund to contribute $10,000 per year to your favorite charity. This is a great strategy if you are looking at doing a Roth conversion, or if you have a large retirement plan distribution, or some other unique income opportunity that you want to offset. The next strategy is the charitable remainder trust. This one is huge for people with appreciated assets. Think crypto, real estate, maybe in antiques that they inherited. This is a really, really unique strategy that doesn't get described enough to clients. And here's what the basics of a charitable remainder trust are. You put money into a charitable remainder trust, and every year you or a beneficiary that you name receive income from that trust. And when the trust has run its course, what remains in the trust gets donated to a charity that you have named in advance. So here's the opportunities that people have with this. Let's suppose you're a crypto investor and you've got some huge gains. You don't really need that money right now. You might want to give it to charity. You might want to live off some of it. You're not really sure. So you put it into a charitable remainder trust. You live off that money. You can get payments every year, and there are some rules and some percentages of income that you have to take from it. And you can talk with your tax strategist more about that in detail. And every year that charitable remainder trust balance grows, That payment that you receive as income, and in the end, whatever is left in that trust goes to charity. So I've seen this used when someone has received, their grandmother's antique artifact, and they don't know what to do with this thing, but they look it up and it's worth far more than they expected. They don't really want to pay the tax on it. They're not sure what to do. How can they avoid a tax hit on this thing? You can donate it to your charitable remainder trust, then have it sold, and all the funds go there, and you get the benefit both of income and of making a charitable contribution. Next up is the qualified charitable distribution. This is a strategy for those individuals who are age 70 and a half or up, who have an IRA, and they are required to take a required minimum distribution, RMD, annually. Let's suppose that's you and you don't really need that money to live off of. You can have your IRA make a contribution directly to a charity called a QCD, Qualified Charitable Distribution, and it counts as your RMD for the year. Now, you don't get to write this off, take a deduction as a charitable contribution, but you do get to not claim it as income. So it's the same bottom line difference. And it's a great strategy for those who are 70 and a half and don't need all the funds that are in their IRA. The next strategy is one that's been around a long time, and that's bunching your charitable contributions into 1 year so that you're able to itemize your deductions that year. So this might look like every other year you make charitable contributions and write off your charitable contributions by itemizing your deductions in that year, and in the other years you take the standard deduction. So this works for those individuals who aren't giving large amounts, who aren't going to be itemizing their deductions every year, but still want to be able to receive some benefit. Now, new for 2026 is a really great opportunity for all taxpayers. What the One Big Beautiful Bill Act did is it allowed in 2026 and beyond taxpayers who take the standard deduction, that will be $16,100 for single individuals in 2026, they can write off up to an additional $1,000 in charitable contributions, effectively increasing their standard deduction from $16,100 to $17,100. And the math is similar for married couples filing jointly. With a standard deduction of $33,200, they can now claim up to $2,000 in charitable contributions on their tax return, getting the benefit of itemizing at least some of their charitable contributions. I would be remiss if I didn't cover at least a couple of pitfalls, some fine print here at the very end. If you are making a charitable contribution of $250 or more, you are required to receive a written acknowledgement. That's important for you to have should there ever be an audit, so make sure you get that piece of paper for your paper trail. Secondly, it is only contributions to a qualified charity or religious organization that count towards a charitable deduction on your tax return. Third, and this is one that I get asked about a lot, your time is not a charitable deduction. It's a great thing for you to do, to volunteer, to put in time with your favorite charity, but there isn't a way for you to write that off on your tax return. You can, however, deduct the miles that you drove back and forth to that charity to donate your time. The last bit of fine print has to do with crowdfunding websites like GoFundMe. Contributions made through GoFundMe are rarely tax deductible, and that's because the IRS only allows a charitable deduction for contributions to a qualified charity or religious organization. And those types of organizations rarely use crowdfunding platforms due to the fees associated with them. I don't say this at all to discourage you from using GoFundMe and other crowdfunding websites. It's a great service they provide to help raise funds for those in need, but those contributions aren't deductible and cannot be claimed as deduction on your tax return. So my question for you is, which one of these tax strategies is most interesting to you? Which one do you think you might implement in 2026? Now is a great time for you to begin your charitable journey. At Management Accounting, our tax strategists work with clients to implement strategies like these and many others to reduce taxes and increase wealth. And if you'd like to learn more, you can click the link in the description below. Thank you for watching this video. If you enjoyed this content, please hit like and subscribe below. And if you'd like to learn more about how to work with one of the tax strategists at Management Accounting, please hit the link in the description below.